You're listening to The Real Investment Show.
Welcome back to Coast Morning at 6:33 as we get this Tuesday edition. On the website now is our Technically Speaking post. Just doing some work over the weekend, really kind of looking at markets from, daily, weekly, monthly perspectives. And it's pretty amazing just how extreme on kind of a long-term basis that markets have gotten. We talked about this is always the case, right? So yesterday I was talking about moving averages, how moving averages act like gravity, and the further that prices move away from a moving average, the reason you have a moving average is because it's the average price over a certain period of time, right? So, and in order to have an average, that means prices have to trade above and below that average over a time frame, right? So that's why it's an average. So I said yesterday, of course, is that the further that prices move away from gravitational, or from the moving average, the gravitational pull of that moving average becomes greater. Well, there's always the rocket scientist in the crowd that is like, the R squared of the square root of the subterranean, X, Y axis says that, I get it. That's not the way gravity really works. If I get to the atmosphere, gravitational pulls, I get that. We're talking about moving averages in the stock market, okay? Trying to use some simplistic terminology for people to understand how moving averages work.
Don't let science ruin a good illustration.
I'm just trying to make a point here that people can get their head around a bit.
Hey, his heart's in the right place.
Exactly. It's always the one, right? It's always the one. It's always the one. Anyway, we appreciate you very much.
We love you, Dale.
Yes, we do. We love all the comments. Now, back to the point.
Meanwhile, back on the show.
So, in the article today, though, it's on the website, so Technically Speaking post today, I've got some charts for you that really kind of look at these more extreme technical deviations of the market. And we're doing some things currently that we haven't done like ever. In terms of how extended markets are above long-term moving averages, et cetera. And the important thing about moving averages is that, they don't necessarily mean that you're immediately going to have a big correction, right? That's not what they mean. What they do mean, though, is that over time frames, depending on which time frame you're looking at, prices are going to trade above and below that average at some point. And this happens more often than you expect, even on short-term basis, right? I mean, we tend to forget that in February of 2020, markets were at all-time highs, and nobody was expecting a correction back to the 200-day moving average. Not only did we correct back to the 200-day moving average, we flipped to the other side of that to a more extreme degree in March, right? 35% decline. Nobody was expecting that in February. So these things tend to happen very unexpectedly, and then we forget about them because markets come back and we forget about those events. And we're like, okay, well, that can never happen again. And what's amazing to me is how rapidly after that 35% decline in March of last year that we've all forgotten about it. I've been on the Twitter debates lately with people who, are talking about, well, that can't happen again. We won't have another correction like that. Blah, 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 blah. You don't know that. And the one thing that you do know is that when everybody's kind of on one side of the boat, that's when things happen. Bob Farrell was one of the greatest kind of, technician market gurus for a long time. And he has his 10 investing rules. And one of them is, one of my favorites is bull markets are more fun than bear markets. No kidding. But one of his rules is that when everybody agrees, something else tends to happen. And this is kind of really the basis of contrarian investing. And, right now, no matter where you look, everybody is super optimistic about the markets. Markets are going to go up. The dollar's going to, this is what we were talking about earlier, the dollar's going to decline. The markets are going to go up. It's all about emerging markets. Maybe the case. But, we're watching, virus cases surge all around the world, and we're starting to shut down economies again. That's certainly not good for emerging market countries. The hopes are that we're going to get a vaccine and it's going to cure everybody and we won't have the vaccine anymore. But now we've got these, spin-off viruses that are coming up, these mutated versions, and don't know if those are, the vaccine will be effective against those or not. So there's a lot of things. And the point is that when everybody is kind of on one side of the boat, it doesn't take much to trigger a change of sentiment. And remember that the market is only driven by buyers and sellers. And we actually wrote an article yesterday about that says, literally there is no cash on the sideline. This is kind of one of the big things about the markets lately. You hear this a lot in the media, and you always hear this argument whenever markets are trying to justify why prices are where they are. Although there's lots of cash on the sidelines. No, there's no cash on the sidelines. First of all, just from the fundamental basis, most people are fully invested, no matter kind of how you measure it. Retail investors are, got some of the highest level of equity allocations ever on record. Mutual fund managers have record low levels of cash. Professional managers are leveraged long. They've got no cash and they're actually on leverage now. So there's no cash on the sidelines. There's cash in money markets, but that's for mostly corporate cash, and that's for paying payroll and expenses, and that money's not coming into the stock market. But the idea is that, there's all this money sitting there, and if it came into the markets, it's going to push prices up, and that's true. But the reason is not because there's cash on the sidelines. There is never cash on the sidelines, because if a dollar comes into the market, somebody has to sell $1 worth of their stock. So the net effect is zero. In every transaction, there's a buyer and the seller. What makes the difference is the price. Now, this is the key point. In a market that's going up, you have fewer people wanting to sell than the number of people wanting to buy. So buyers have to continue to pay up on prices in order to get sellers to sell. Now, I want you to think about this for a second, because this is a really important point about how markets are going to work and eventually you're going to turn. Everybody thinks the market's going to go up. So buyers are willing to pay continually higher prices, and sellers are on the other side going, yeah, I'll sell you my Tesla stock, right? But pay me $800 for it, right? And so people pay up for it. It's just like selling anything else. You want to sell your house. If houses are selling in your neighborhood like hotcakes, you're not going to sell your house at a price lower than everybody else, right? You're going to ask a higher price than the last guy that sold, because there's so much demand for houses, right? So you're always going to ask for the highest price. Same way in the stock market. People are willing to sell. There are people always willing to sell, because you got to have a transaction, but it's always at what price they're willing to sell. So buyers have to keep paying up. Eventually, for some reason, and we don't know what it will be, some random thing occurs. And buyers go, you know what? I'm not really comfortable paying a higher price for those shares. The moment that happens, everybody that's been waiting for the greater fool, which is this is the greater fool theory, there's always somebody out there willing to pay a higher price. When sellers realize there is no greater fool, they immediately all rush to sell at one time. This is when the tables turn. And this is the reason you have big corrections in markets. It is at that point that buyers go, yeah, I'll take the stock off your hands, but it's going to be at a lower price. And the price starts to fall. As the price begins to fall, more sellers realize that there's no more buyers out there, and they all rush in at once to sell. And that's why you have very sharp declines in markets, because buyers live lower. Sellers live higher, buyers live lower. And buyers start going, you know what? Yeah, I'll buy your stock from you, but the price is going to be way down there. And that's why prices can drop so sharply like we saw last March. We're currently in that environment once again, like we were back in February, where markets are extremely extended, extremely deviated from long-term means, etc., sellers have been living higher at this point because there's been plenty of buyers up to this point to continue to buy those shares. The question is what changes that dynamic? What changes the sentiment? What changes the attitude to where buyers eventually say, I'm not willing to pay a higher price? And at that moment, that is where sellers will begin to show up in mass to liquidate shares. And when it occurs, it'll occur fast. And a lot of this has to do with the problem of passive investing now, because when people start dumping shares, they dump ETFs, which are entire baskets of stocks. So this is why you see a lot of very high correlation between markets now. Everything kind of goes up together, everything kind of goes down together. But when the sellers show up, they're going to show up in mass and they're going to dump indiscriminately positions. And particularly when ETFs show up and start selling, you're going to sell entire sectors and markets all at one time. But again, it's what's important to understand is how the market dynamics work. There is no cash on the sidelines. It is the lack of sellers that causes prices to rise. But at some point, that dynamic changes for whatever reason. And we never know what the reason is going to be. But whenever that reason shows up and it changes that sentiment of buyers and sellers, that's what you need to be aware of. Quick break, we'll be back and wrap up the show. I'm your host, Lance Roberts, for The Real Investment Show. RealInvestmentAdvice.com. That's RealInvestmentAdvice.com. We'll be right back.
You're listening to The Real Investment Show.
Get 2020 off on the right foot with our next Candid Coffee Financial Bootcamp. Get fiscal with Richard Rosso and Danny Ratliff and learn the landmines to avoid, tax advantages we see, and money tips you need to know. Our next Candid Coffee can better prepare you for the changes we'll see in the new year with a new administration. Get fiscal with Ratliff and Rosso. Register for the 2021 Financial Bootcamp edition of Candid Coffee Saturday, January 16th at RIAadvisors.com. RIAadvisors.com.